welcome to our 2024 market outlook. Before we get started, everyone here at Platania Financial wishes all of you a very happy and healthy new year. During this presentation, Jim and I will touch on the economy as well as the stock and bond markets. We'll try to keep this presentation brief, yet still informative. So last year, we had almost every economist on TV telling us that we were going to have a recession. Throughout the year in our conversations with you, Jim and I said that we would not be surprised at all if we didn't have one. Now looking back, we know that the economy was very strong and we avoided recession. We feel this year, unfortunately, will be different as the economy is expected to slow. This slide shows that in the fourth quarter of last year, we saw prices fall in both durable goods as well as services. In addition, we have high levels of consumer debt with credit cards and auto loans at very high levels and experiencing serious delinquencies. We believe this will cause the spending splurge that we've seen over the last couple of years to slow significantly. LPL Financial puts out their forecasts every year for growth as well as inflation. And you can see from this slide that they're expecting minimal growth, with the United States having about a 1% GDP and in Europe having about 0.5%, maybe a little bit more. The good news is, however, inflation is forecast to be 2.8% in the US and 2.5% in Europe. So we believe the base case is we're going to have a recession. It'll be mild. And I think we have to keep in mind that recessions are normal and they're actually healthy long-term for the overall markets.
Stock market finished 2023 on a high note, and we believe that momentum will carry through to 2024 with potential for a mid to high single-digit gain. We estimate a fair value range for the S&P 500 at the end of 2024 between 48.50 and 49.50. The next 12 months of this bull market get underway, market history tells us that solid gains may lie ahead. In the second year of the 12 such bull markets since 1950, the S&P 500 has gained an average of 12.6% and was positive each time. A gain of this magnitude seems reasonable given the potential for support from the Fed as inflation falls. We believe that earnings will accelerate in 2024, even despite some economic headwinds. Reversals of 2023 earnings declines by the healthcare and the natural resource sectors, along with increased earnings growth in the technology sector, will help drive a turnaround in overall earnings. Beyond economic growth, how companies manage waning pricing power as inflation falls is key to the earnings outlook. With that said, stock valuations are high by most measures. The price-to-earnings ratio based on the consensus S&P 500 earnings per share estimate for the next 12 months is 18.8, above long-term averages in the 15 to 16 range. Factoring in interest rates allows for a more complete valuation assessment.
Well, we feel that the bond market is getting back to normal. Well, let's take a look at where interest rates have been for more than 100 years, going back to 1880, actually. They average about 3 to 5%, with the exception of the 70s, which interest rates were very high, as we know. And really, since the crash in 2008, they've been extremely low, but they've averaged, in the range of 3 to 5%. Now, we think that interest rates will come back to that sort of normal range. And earlier I mentioned that, we feel that we will be moving into a mild recession sometime this year. In that scenario, we'd be looking at a 2-year Treasury yield of just under 4%. The 10-year global bond yields would be in the range of 2.5%. But the 10-year Treasury, which is really an important interest rate, is because mortgages are often tied, to the 10-year. But we feel that the range could be 3.75% to 4.25% range, almost where they are now. We're currently at this recording about 4%. So, we think they'll be in here throughout the year, a little lower, a little higher. Now, that's if we have a mild recession, but we have to take into account if there are two other scenarios that could develop. First scenario being that we just don't have a mild recession. We go into either a hard landing or actually just your traditional recession, which would cause interest rates to go down. And we could be looking at a 2-year Treasury at 3%, we could be looking at the 10-year treasury in the low 3% range. Now, if the economy continues to show strength, or it pauses and then reaccelerates, we'd be in the scenario where we're going to see rates go higher, and the 10-year treasury could be, closer to 6%, and the 2-year treasury could be, in that 5.5% to 6% range as well. We really don't know, but one thing is for sure, it's going to be an interesting year. Plan on volatility, because we're going to have plenty of that, especially with an election in November. But in any case, we'll get through it. Unfortunately, we're going to have to continue to be patient, think, a little bit longer term, which is often difficult to do. But think a little bit more than 1 or 2 years out, and we've got to continue to be patient. We hope that you enjoyed this year's Outlook presentation, and thank you for taking time to watch it. Again, we wish you a happy and healthy new year. And call us if you have any questions regarding anything we discussed during this presentation.
Please review these important disclosures.